And I'm going to introduce our last moderator for the day, Jennifer Edgar. Jennifer is an experienced professional with a demonstrated history in the commercial risk management and insurance industry, building strong connections with the global market, as well as clients from all industry spaces. Jennifer excels in technical sales and communication skills, with a focus on developing relationships through all levels of the business community, internally and externally. She thrives on working with a team, helping to create unique and creative solutions. And her fun fact, I'll let her share that with you. So here's your microphone.
Thank you. I guess my fun fact would be I'm having a baby in 6 weeks, so that's always fun. But thank you. I'm exhausted, I'm not gonna lie, but I just wanted to say thanks so much for introducing us, and to obviously the whole consortium for the amazing few days that they've put on, and thanks to all of you for sticking around for the riveting subject of insurance here. So without further ado, I will introduce each of my pals. Firstly is Kerem Kolcuoglu, who, fun fact, lives in Bermuda and loves dogs, aside from spicy shirts. Yeah, go for it.
Test. Hello. Hi, everybody. Thanks for sticking it out with us. Appreciate you being interested in insurance. But we're going to try to keep it interesting for you. I wore an interesting shirt. There's an interesting shirt blown up there, too. This is my mom's nightmare for being publicly speaking and in front of an audience with terrible choice of clothing. But with that, just to give a background myself, I'm the managing partner of a firm called Penrose Partners. We're based in Canada and Bermuda. I'm Canadian myself. I live in Bermuda. I get a lot of exposure into the digital asset and insurance industry, and kind of identifying the overlaps between our industry and the traditional old insurance industry that we apparently really need to utilize or innovate on how we learn from that industry and apply it using our own technology. So I've been working with the Bermuda government alongside the Canadian government, doing trade missions, helping Canadian companies go offshore, embrace digital asset regulation, learn, and be able to bring that back to Canada. So I'm looking to bring kind of that flavor. I've got great experience on the custody risk side and learning from gentlemen on this panel and kind of working with them. So yeah, happy to take on some questions, and I'll let the rest go.
Oh, I'll go for it. Thank you, Kerem. Next, we have Alex Daskalov, who not only an avid cyclist, but he became interested in insurance early from a biomedical angle, eventually marrying that with his longstanding love for Bitcoin. But I will also say, Alex, the way to his heart is charcoal barbecue. And in fact, he has left a litter of charcoal barbecuing utilities around the world. Everywhere that he travels, he buys them so that he has them with him. So
yeah, thanks for that, Jen. That last part is definitely true. So I'm Alex, co-founder CEO of Nox. Nox came to life in 2018. And in the earliest days, we acted as a Bitcoin custodian. The purpose for building that system was to objectively reduce the risk of theft and loss of the infrastructure that we developed. In the past year, we have really transformed ourselves into a custody infrastructure provider by way of a partnership that we did and announced earlier this year with Tetra Trust, powering part of their cold custody stack. In the future, getting really into expanding insurance policies. We spent the past 4 years hand in hand with insurance markets, helping to craft novel policies, improving policies, working on reducing premiums, expanding capacity, and certainly widening the scope of coverage, which is important for maintaining and managing risk in this space.
thanks so much, Alex. Next, we have George Bordianu. Outside of work, George is a bit of a self-defense nut, so look out, anybody. He has a Krav Maga black belt, Muay Thai blue shorts, and is a certified instructor teaching both. So yeah, definitely look out.
Awesome stuff. I guess it kind of comes with the territory and with the job. I'm mostly seeing lights, by the way, so I'm just going to assume there's an audience. I'm George, and I'm the co-founder and CEO of Balance. You can find us on balance.ca. We are Canada's largest digital asset custodian. We don't have qualified status, so we don't sell to any dealers, advisors, or funds, but we do work with trading and prop trader desks, lenders, ATM networks, high net worth individuals. Last year was a very interesting year for us, where at some point in November we had surpassed 2.5 billion worth of assets in custody, after the most recent market drop, that's currently hovering around 750 million to about 1 billion. Nonetheless, we have been working hard to get that top of the sales funnel in place, and the phone started ringing again on my end. So I don't believe that there's this much of a crypto winter anymore, and I hope maybe this is the panel that kickstarts the crypto spring.
Awesome, thanks, George. Last but not least, absolutely not least, is Ryan Wass. And just to keep things really interesting, Ryan is incredible and avid skier, for the record. But the first time Ryan and I met earlier this year, actually, we was a day at the ski hill, work related. There was some drinks consumed, a desperate search in the snow for a lost cell phone, corporate cell phone, by the way. And Ryan is convinced this is also the night I got pregnant. So, but not by him, but
there was a hot tub party that I skipped out on. That's all I gotta say.
No comment.
I'm Ryan Wass. I've co-founded and serve as the CEO of a small risk advisory firm. We do specialist risk management advice and corporate insurance representation. Have an acute interest in the space, have worked with Calais and the CBC and its prior entities for quite a while. Our firm does some work in the captive space as well, and that is us. So I'll come challenge these guys and be a bit of a contrarian to keep a very dry topic interesting today.
Awesome. Thanks, Ryan, and thanks all of you for being on the panel. So let's get started. Firstly, all businesses need insurance to function, but cryptocurrency companies have struggled to find providers that are really understanding of the industry as a whole. What are the big challenges to accessing these essential services for the crypto sector? And I'm just gonna have this be an open dialogue here. So feel free to jump in where you guys wish.
Sure, yeah. So I mean, first I'd like to split this into two broad categories. One is the risk category that, say, myself and Knox have been really focused on the past few years, which is the risk of theft and loss of assets held in custody. So that's certainly one category, the one that we, it's close to my heart. That one is, as we exist, relatively easy to attain by virtue of using Tetra and having Tetra purchase insurance on behalf of any customer. Another set of categories, though, D&O, E&O, all of those have been a challenge, I think, for us and for many others in the industry. And I think it's an nascent industry. Many of the insurers see this as a risky place for them to produce policies, and really, it's on us, I think, to educate them and help improve the state of coverage there.
Yeah, I'd build on that, and I would say that I think this is the journey that most industries go on. Cannabis had the exact same journey. It's an industry that requires a huge amount of data to make decisions, and they don't understand. And not only do they not understand new and novel business, I think that the very beginning stages of this industry and what the decentralization in finance poses, that is a board level concern. So even the underwriting talent that wants to support the industry, many of them are running into board level opposition where their companies just say, we don't support this industry because it's destabilizing or potentially destabilizing to us.
I would add reinsurance treaties to those companies as well.
I guess just to chime in for a second here and to tell you a bit about our story, we've been insured for a couple of years at this point, and the first policy that we placed through Gallagher took us like roughly 10 months to broker, and then the next policy that we placed took us roughly 8 months, and then the third policy took us roughly 4 months. So it has been getting better. The biggest challenge, especially in the early days, because we're dealing with such specialized types of insurance. In our case, in particular, as a custodian, for example, we have one particular type of policy which historically has been applying to the offline storage piece. Those are typically called vault risk insurance policies. And then you have what are called crypto crime policies, which typically apply to warm infrastructure, which like to cover things such as computer fraud and telephone fraud and property and premises and in transit, and tend to look a little bit closer to what a financial institution bond would maybe look like. A lot of the underwriters, and believe us, like we've been declined by pretty much every underwriter that exists in Canada. A lot of the underwriters that we eventually did end up working with, out of Europe and In the case of Worm, like even out of Bermuda, for them, they would bucket the entire, all of the types of businesses within the asset class within the same bucket. So they would say, look, we just don't want to underwrite crypto. We don't care if you're a custodian or if you're a trading platform or if you're a lender or if you're a prop trading desk. And the loss scenarios and the security profile of each of those types of businesses are wildly different. So when it comes down to assessing risk, there was a lot of education that had to happen for these underwriters for them to be able to figure out what premiums to charge. And then when it came down to the specifics of each of these types of business, as a custodian, we have a separate policy for offline and one for warm. And what are the distinctions between those? That was the second big gap that we had to cross. And granted, like this, what are called the in-specie policies, the vault risk insurance ones are getting closer to the crypto crime policies, to the point where in 2022, you have underwriters that might be comfortable to say on an insurance certificate that your vault risk insurance is actually crypto crime. There's still a small gap to cross there. And I believe that's going to be the next hurdle.
Maybe I could just add a little bit on the education piece. And I think we talk a lot about education in our industry, and I think it is a community goal that we all have to work on that together and get enterprise executives, in this case, insurance executives, to understand that digital assets could be competitive or disruptive to their businesses, but there's a lot of opportunity for them too. So just coming from the Bermuda angle, where I go to a golf club and it's all insurance executives just drinking beers and doing deals, and it's kind of like everything's within their circle, and it's a very relationship based, and they don't really want to move out of their comfort zones. They're making a lot of money in insurance. Like, they're doing pretty well. Like, don't worry about those guys. They're fine. But just to be able to communicate, like George and Alex are talking about the specific types of risk, but doing that from an educational angle rather than like a sales angle, and rather than from a fearful angle of them not understanding what it is, but trying to communicate that there are similarities between existing risk categories that they are engaging with, showing how cyber policies are generating so much money for those insurers, and maybe digital asset risk and cyber risk overlap, and the same margins can exist. So I think if you ever speak to an insurance broker or an insurance executive, I think it's on all of us to try to stump a few of the myths or dangers of the space and kind of flip the narrative of saying it is a risky space, and with risk comes opportunity, and with opportunity comes revenues and profits for these insurance businesses. So I think there is an education gap. I think there is a relationship gap. Crypto people are often sticking through into the crypto groups and not spilling into big finance conferences often, or insurance conferences. So I would challenge everyone here to go to an insurance conference and be the digital asset or blockchain ambassador in the room, speaking eloquently to the topic and talking about risk and speaking their language that they understand, and seeing over time that kind of perspective from the enterprise world change, and have them looking for opportunity. In parallel, we should also be looking for how do we sidestep the insurers and innovate within our industry as well to give them that fear of missing out.
I think the challenge on that, though, is the capital that is available in the standard insurance industry, whether it is domestic, whether it's Lloyd's of London, whether it's the reinsurance or the retrocession, like that is just an unavoidably large, significant play. But the one thing from a mindset standpoint, I would encourage people in the room, if you're talking with insurance executives, is how they underwrite. The biggest obstacle right now is they can't make an investment decision, broadly speaking, because they don't understand the class that they're looking to invest in, because the historical data they would use for the actuarial model just simply doesn't exist. So I think industry has a huge obligation, if it wants to mature the insurance availability. The industry has to look at finding within the various sectors of the industry standard data sets that can be presented to the insurance company in anonymized aggregate basis to say, this is the standards with which we judge good performance, never mind great performance. I understand the competitive realities here, but we have to get to certain levels of standards. Otherwise, the insurance company is just not going to open up the capacity.
Yeah, and I would agree there with, almost taking sight to some of the industries and emerging risk topics that have come before, like oil and gas, construction, cannabis. I mean, those might be a bit more homogenous than the digital asset space, but I think that there is an ownership on all of you as, end users of the insurance products you're purchasing to really differentiate yourselves. The insurance industry here in Canada, I mean, yes, a tad antiquated, but it is a mature industry, and they're not recreating the wheel here. We've seen it in the past, but it's really, there is some ownership to differentiate yourselves. And I think it's also, to Ryan's point, a bit bigger than just the insurance industry. It's the investment behind it as well. So
there's just very quickly, there's also something to be said about building alternatives. In our case, as a custodian, we could never do something like this. But for example, if I don't know, you're building a certain class of product, maybe there's something to be said about going for an on-chain insurance product like Maple Finance instead of applying for your typical underwriting pools. So once those underwriters see that they are losing business to this new emerging insurance models that are on-chain, it might trigger a light bulb on their end to say, we want to be an active part of the space and participate.
Thanks, guys. Next question. With recent major failures of crypto lenders and layer one platforms like Terra, consumer safety is a critical issue in the industry. What role do you perceive insurance plays in protecting crypto users?
Yeah, I mean, certainly. So I think, of course, for retail customers of exchanges or lenders or anything of the sort, knowing that the custody is offloaded to a responsible third party, and knowing that potentially there's some insurance in place there is a very helpful point for anyone potentially exposed. I think an important point needs to be made, though, that insurance, of course, is not a panacea. For example, if a lender is rehypothecating, there's nothing that's going to save you from an insurance perspective. So it's important to understand all the risks that could potentially exist from a counterparty. And I think insurance is an important piece when you are using a third-party custodian. But it is very important that you understand that it has the regulatory status that will not allow it to do things like rehypothecate.
I would back up the conversation a little bit, and I would say that there's two significant classes of risk facing crypto users and companies in crypto. That's pure risk, which is chance of loss or not. Think of your building's going to catch fire or it's not. And then there's speculative risk. And so a lot of the consumer protection falls into the category of speculative risk, which insurance is not designed for. That there's a lot of other products that, credit default swaps and so forth like that are really not insurance instruments. And I absolutely love the point. Insurance is not a panacea. It's not going to solve everything. And I think the role of the regulator is huge here. I think insurance needs to be remembered as a risk financing tool, and that's really all it is. It's not meant to be a cure-all.
Yeah, the reality is no one's going to insure you against losing money in the market, right? That's never going to be the case. Now, just to very briefly chime in with respect to what role will insurance end up playing for getting consumer protection in place. Not as great of a role as it could if the premiums would be a lot lower. So I'll just say this. The reality of it is, again, I'm taking the custodian perspective because this is what we do. We can't insure the assets that we have in custody in full, the same way that you cannot insure your house in full or your car in full. Like, that's just not how the economics of the transactions work. So what you want to be looking at is the ratio. What percentage of the assets that the custodian that I'm using holds actually have insured. And as a general rule of thumb, and maybe there might be people in this room that might disagree, regulators worldwide tend to look at about, like if you have 1% of the nominal assets that you have in custody insured, like that's sufficient, that's good enough for them. So you are dealing with ratios of like 1 to 100, 1 to 50, 1 to 300 in the case of the very large custodians that grew quickly and didn't develop the policies. So the reality of the fact is, if there is a complete disaster and explosion, no amount of insurance coverage or policies are necessarily going to rescue those users. They will be getting back cents on the dollar. There's a huge, aspect in our line of business, and just broadly speaking, when you're dealing with a large amount of assets, it's the same in traditional finance as well, of not messing up. The biggest insurance policy that I'm aware of is 500 million at some of the large banks around, right? So.
Yeah. Certainly agree with a lot of those points. Certainly, given our focus on insurance, it is still possible, and later we'll talk about regulators and what they might do looking into the industry. I think there is more insurance capacity than perhaps the regulators appreciate. One of the things that we had focused on from early days was to say we really believe in dedicated limits, so that when a customer approaches us, we could say, we will put you down as a loss payee in the policy. We'll make sure that the limit that is purchased is earmarked for you and you alone. And happy to say that we've carried that forward with Tetra Trust, and we have in the past enabled one-to-one insurance coverage for various customers. At the same time, it is true that the insurance industry broadly has a capacity problem. Today we have something like $100 billion worth of assets held in centralized custody. Very generously speaking, 2% of that is insured. And you could not produce, with the flick of a switch, $100 billion worth of capacity limit today.
There's a lot of analogs to this, though. I from an insurance industry, I'll talk about named windstorm in standard property. Most people in the continental United States do not purchase named windstorm because it's just simply not an economic way to transfer that risk. That's risk that resides with the government. And I think there's a lot of structural risk within the industry that, one, intentional act in a digital space, intentional act exclusion will never be removed. So to look to insurance to have the risk of failure where you have a bad actor in an organization, that's just defeats the entire purpose of insurance. So I think there's certain hurdles that we will never overcome, and there's certain hurdles that we will. I also think that if we segment the conversation down, there's huge differences between hot storage and cold storage. And it's rapidly escalating the understanding within the underwriting community of what those differences are, because we will expand capacity in certain classes far faster. It's already there, where you're seeing the D&O market dramatically change for companies in the crypto space from where it was 2 or 3 years ago. One of the world's largest syndicates at Lloyd's is now putting huge capacity into this space, and 2 years ago they weren't.
Great. Thanks, guys. Moving along here. And sort of on the same token, insurance is also important for holders of cryptocurrencies, like corporations and investment firms that hold Bitcoin on their balance sheets. What should these businesses look for in insurance products?
I can start that off, and I think it plays onto what these guys are just talking about with the types of risk. The centralized cold custody risk, I think, is the easiest one to start scaling things in an institutional perspective. I think, we've seen even our industry mishandle private keys or responsibility around private key management. So whether it be a Quadriga situation or a Mt. Gox situation from an external standpoint, and like security failures or control failures from our industry, we want to have everyone that has at an institutional grade or institutional scale using a third-party custodian, like the gentlemen that are operating a couple businesses up here, because we're trying to save everyone from themselves. Like managing your own private keys and having the access to your own wealth sounds awesome, but it comes with a lot of risk, right? And that risk should be and can be transferred to the insurance markets and people that are professionals at taking on and underwriting types of risk. So I think whether it be exchanges or crypto companies that have achieved that institutional scale, or businesses that are coming into the digital asset industry and getting exposure on their balance sheets, should be utilizing third-party custody and the insurance that comes with that, because that is there today. And again, the speculative risk is definitely very out of the question, and picking the right third parties to invest with, I think that's always going to be there. You can choose a Celsius versus a Canadian company like Ledin that didn't do the things that Celsius did, and trying to identify the leaders behind these institutions or these service providers. That's always going to be a part of the game. So you can't just say, I'm sure they have insurance. They, like these gentlemen had said, not much of the custody is actually insured today, but these are the leaders that are working on that, right? And communicating with the insurance markets so that institutions can come in and just at least check the box that these assets are insurable. And I think we're going to see a lot more institutional assets move into the space when the capacity also catches up a little bit too.
I think one of the challenges here is there's two competing priorities that overlap but are very distinct. There's this industry becoming fully insurable, which creates huge legitimacy for the industry in the maturation cycle. So I think that's one. And then I think there's the consumer protection side of it, which is more on the regulatory angle of if you look at multiple other industries that are now mature and they have huge public interest pieces, a lot of them will have absolute liability pinned on them. And then it is within the regulations up to the individual player on how they want to finance that risk, right? And I think we really got to segment and focus the conversation from my lens on that, because the risks of a mining operation are not anywhere close to the risks of a custodial operation. And the trying to access the market from a singular industry perspective is not going to yield a great deal of success. And this is where I'm going to beat the drum again on finding standards for the sectors within this industry is so vitally important.
I guess just to get back to the question, and I'll try to give both sides of it, so you don't say that. Of course, this is what I would say as a custodian. Not to discourage anyone from doing self-custody, but if you are doing self-custody, don't try to package insurance, because believe me, it'll be, like the 6 months to 1 year journey at the best if you're working with a top world-class broker that has access to those underwriters and knows what they're doing, right? So the way I see it is, if you are to use a custodian, and then I'll go back into the question of what should you be looking for in terms of an insurance product, I'll give the questions they should ask that custodian of with regards to their insurance policy. You can use a third-party custodian, which effectively allows you to do a softer version of not your keys, not your assets. It's not your legal title, not your assets, right? Rather than keeping your assets with some centralized lending platform or some trading and exchange platform where effectively they take the title on those assets, where when you hold them on the platform itself and you're sitting at some other end of a crypto contract to buy, sell, and hold through them, run your trading activity, take the assets out, put them with a custodian. You have the legal title. You know that even if the custodian becomes insolvent, the creditors are not going to be able to get into them. And then if you want to take some of those out into self-custody and, with all the advantages, I control it on my own. I don't have to pay insurance. I don't have to pay custodian. Maybe if I do my own transaction signing and broadcasting, I don't need to pay a, payment services provider of any sorts. That's great. Now, I'll add this for 10 seconds quickly. What should you ask your custodian if, with regards to their insurance policy, if you want to use one? Well, what's your single loss limit? What's your aggregate loss limit? How much of that limit have you already gone through? Like if you had any sort of loss events, what is your deductible? The deductible is effectively up to this certain amount. The entity itself, say custodian, would have to cover the loss for the client, and then the insurance would start paying on top of that, right? And then what are the loss scenarios that are covered? What are your exclusions within the policy? Can I see a certificate from your broker? And then if all of that is good, off you go.
Yeah, no, I think, those are some great things certainly to read into any insurance policy. The other point I'll make is, the devil's in the details with the insurance policies. So frankly, just ask to read the policy and go through it and have everyone understand what are the events that can occur and how can you be certain that a claim event can be made. When we first started looking at insurance policies years ago, they had so many exclusions and carve-outs that I came to realize people were buying insurance not so that a claim event could be made, but so that they could answer yes to the question, do you have insurance? That's really the state of affairs that I felt at the time. So we worked really hard to expand the scope of coverage of policies, and we could spend an hour talking about what a good policy is, but to really directly answer the question, for me, I've always said it this way, make sure that loss by way of anything looking like key destruction is covered, loss by external theft, loss by internal theft due to internal collusion. Of course, one of the most important, as a custodian, you necessarily need to be able to move funds on behalf of customers. So how do you ensure that that is never going to happen, leading to a theft event? And then the meta property, which was especially missing when we got started, is make sure that that is the case from cradle to grave across the entire key life cycle, that there's no exclusion that says, not at time of transport, at generation, et cetera, et cetera. For us, it was always, you can't claim to have the first 3 claims ever made if there's any hole within the key life cycle.
Yes, I just want to chime in and add on top of this. This is paramount for any custodian that you're going to use. Make sure that they have that. Obviously, like we all have this. Don't come search me after the conference to ask me where the Bitcoin is. I don't have access to it. I can't move it. If you don't want to see some cool gun and knife designs, like I can show you those. But make sure that the custodian that you're working with has internal collusion and fraud and dishonest acts of the custodian covered by the policy.
And if I may, I might just go a little bit off script here, but just to kind of circle this back to not just this question, but the panel at large being centered around traditional insurance placement. There are traditional principles to that in the nature of how a company tailors their risk management plan and transfers their risk via insurance. And, the first part of that is defining your own risk. So not just, rolling over to whatever transactional approach your service providers or you might want to take in thinking about the necessity of it, but it's really taking ownership, not to sound like a broken record, taking ownership of, you defining your own risks as well and aligning with the right service providers to help you do that. And so you can figure out what's important to you in, either accepting and retaining, manipulating and adjusting, or transferring completely by way of a traditional insurance product. And we have members on the panel here that are really good examples of taking ownership of that. And so I guess I would pose the question of,
let me jump in and be a contrarian just a second here, because functionally, I can tell you as a risk manager to corporations large and small, if a client of ours asks to see a copy of the insurance policy, I file 13 that. I do not disclose insurance documents ever. Certificate, sure. But in terms of the actual wording, to get that out of a corporation that is offside of risk management 101. You do not disclose that. And so it's going to be very challenging here. And I think where the evolution of this goes is more getting custodians into a bonding space as the fact that there's a third-party certification that this company meets a certain standard. And to disclose insurance to a client, that's a very problematic thing. You can probably get someone convinced to show you their property policy, but in terms of a liability policy, good luck. That will, if there's any corporate attorneys in the room, they are laughing about getting a contract of insurance turned over pre-discovery.
Yeah, I think certainly it depends on the kind of policy. So this is a question that we had early days with when customers came talking to us and working with our brokers. We came to realize really it is important that people can read the wording on that to understand, how well is this buttoned up, and so that they could actually walk through all the possible loss events. Our broker effectively felt, look, there's a reason people don't show their insurance policies for this risk category. They're full of holes. Yours is great. Work with the customers. Get an NDA in place. We don't, openly share when we were a custodian of the policy, but granted, for many policies, you're never going to get that out of the corporation. But I think with this kind, it is important.
Yeah, it's a huge operational risk to do so. So I can obviously show you a certificate. I can walk you through the loss scenarios. Now there is such a thing, term which I've recently learned myself. There's such a thing as say a 31103 endorsement that you can put on that insurance policy, which effectively would say, as far as say securities regulator in Canada is concerned, this insurance policy meets requirements that they would like to see, right? So if you're to use a qualified custodian under 31103, that custodian needs to satisfy certain terms and conditions, and by having that endorsement within the policy and getting that regulatory checkbox to some degree, you can show that endorsement to the client and effectively satisfy them that, look, if this is good enough for a regulator, it should be good enough for you without having to see the full binder.
So Ryan, if I understand correctly, what you want Alex and George to do is open their kimonos, take a good look at each other and agree what is good and what is great, or just what is good, and come to market with some sort of standard like that?
Well, I think there's, again, it comes down to liability, right? In a property standpoint, to go with, if it's digital property, here are the perils that this policy covers. fine. Because digital property is finite. So we've got that, right? We've got with property, there's a finite aspect to the quantum of the loss. With liability, there's not. So there's a competitive advantage when it comes to litigation to withhold your insurance as long as possible. Your insurance, having limits exposed, stated, whatever, in any other industry, nobody goes and says, hey, we've got $100 million limit unless they're contractually obligated to say that. We're in the heart of oil country right now. So the standard $10 million, everybody knows that, but no one's going saying we got 150. It's just, you don't do that, because what happens is then you set the expectations for liability from the party coming after you. And so it's damned if you do, damned if you don't in this world.
Yeah, certainly agree on that point. So some numbers are not necessarily shared and should not be shared. I don't refer to that when I say read the policy. I mean, read the wording, understand the loss events, understand what could transpire, have people walk you through to say, how can you convince me that this will be a valid claim event?
Yeah, so just to be sneaky here a bit, like on my earlier answer, those are the questions that you should be asking someone as a custodian with regards to insurance policy. That doesn't mean that they'll answer them. I'm certainly not going to answer all of them either.
Yeah, and I think something interesting to consider about our space is we do have this narrative around open source and community and decentralization and collaboration, enter your buzzword. But I think it's very interesting when it does apply to something like insurance, where it is more of a secret sauce sometimes of businesses. But, for the ideas of what our industry is doing to innovate in the space, if you just look at a bucket under the decentralized finance, the category of decentralized insurance products. So a couple of projects that are working on this through Bermuda and regulations there, and kind of the regulator being not only digitally asset savvy, but insurance savvy as well. But think about, decentralized insurance risk pools that are not filled with a large traditional reinsurer's capital, but with our capital, our digital capital, right? Being able to participate and take on the risk of our own industry, because we understand the risk of our industry better than the insurance market today. So democratizing access to even vehicles where historically you or I can't really participate in insurance towers. It takes a lot of money and a lot of, experience, and I guess being connected and plugged into that network to put up $500 million of capital to take on risk. But with our decentralized tooling that we have today, there are products and platforms out there that are allowing to democratize that area of finance, which was never close to being retail or even close to being at a SME level of participation. And I think this is what's interesting about Alberta that I'm learning about is captive insurance legislation that is being written, I believe, passed
July 1st.
So that is very interesting. By using decentralized platforms and tools within our own technology industry, but also using legislation to allow businesses to either self-insure and insure themselves, or insure within groups or communities or through sub-segments of our industry. Like a bunch of miners could get together, put up a bunch of digital assets or arguably even Bitcoin, and use that as a combined risk pool, and then create a policy, and all of them benefit from that same policy if their risks align. So it's about using kind of this knowledge and tools that are being created from our industry, and then from a legislative standpoint to create, innovative ways of scaling insurance capacity as well.
And I think this is just the natural maturity cycle. So as capacity increases, and as the insurance participation in this industry matures, then your insurance policy no longer becomes a competitive advantage. Your ability to get the best rating on it and your cost of coverage is a competitive advantage. But the insurance policy, that's when you see in construction, the Canadian Construction Documents Committee, the CAODC from a technical level in oil field, PSAC and so forth like that. Industries came together, coalesced around, this is the wordings we need. And now it's a competition to see who can be the best operator, get the best rating, but it's not withholding wordings that you've developed from your competitors, because you have to have more people using the product to generate the loss experience data and the claims data and the underwriting data to attract the investment of capital by the insurers into the segment.
Absolutely. I feel like we could go back and forth on this one all day, but we do need to move along. As a heavily regulated industry in Canada, crypto's high risk profile for insurers and other financial institutions doesn't align with the true state of the market. How can the crypto industry collaborate with insurers to help them understand how to build products to fit their needs?
First step, we have to separate this industry from cyber insurance, because cyber insurance is the last thing that you want to be correlated to, because it was a product cycle that came in, was developed very quickly, the market brought it on, and it is facing the fastest, highest, most continuous amount of claims in anywhere. We've seen a huge clawback in cyber coverage and capacity there. So we have to separate the two, because we can't paint non-connected offline risk with cyber liability and zero-day exploits and everything that ransomware is creating. That is what I would say.
Fully agreed. Lots of companies that would need errors and omissions like end up getting cyber insurance instead, and it's a lot more expensive to get, and for a lot of the cases don't really need it. So there's an educational gap that underwriters have, which does result in higher premiums. I would say, like, I'm just going to ballpark quantify the risk, and I'll say the premiums that are being charged are probably, say 40-50% more expensive than what they should be if the space would be fully understood. So how can you close some of that gap? Large underwriters can be fairly opaque, but they have been more recently engaging and creating things such as launch pads, and Lloyd's has an interesting one. So I'm saying, if you're insurance minded, and this is one of your hobbies, go engage with them, apply, work, maybe help them build a better actuarial model for the entire industry, and hopefully that should lower those premiums over time, right?
Yeah, certainly I don't have any shortcut to that. It's really a lot of work and spending time with insurance people, which I've been doing for the last 4 years. Came to love the industry. A point maybe to be made there is that the insurance industry is also usually thirsty for more knowledge, and they want to learn about the space. They want to better understand how everything fits together, and they're simply not experts in what we deal with. So not only should you spend the time with them, they will usually enjoy it if you take that time.
And if I may, I might add to that too. As much as the industry and everybody will respect the entrepreneurial passion and the positivity of you as a consumer of their insurance products, they need to hear about the potential failures too, and they need to hear about, maybe not as much positivity as we would like to plug into our forward-looking statements. So it's all of this kind of transparency that's only going to benefit you as a consumer at the end of the day, in helping the industry move the dialogue and move the envelope forward. So I would add that to your point, Alex, for sure.
Yeah, I think for sure that transparency piece is important, and you will gain their trust when they see that you're being straightforward. Ultimately, it's on both of you to understand what the objective risk is, and trying to hide behind failure points is not for anyone's benefit.
If you misrepresent during the underwriting process, the insurance policy is null and void either way. So it's better not.
Yeah.
Yeah, and if anyone wants to come interact with insurance executives in Bermuda, please let me know. You're more than welcome to come with us. In March every year, we do an international technology summit with the Canadian government there. So if you're interested in being a voice for the digital asset community, to talk to regulators as well as insurance professionals and all sorts of different players in our industry, you all have my couch to crash on.
And I would say, got to plug CBC. This is where industry associations are super valuable, because speaking on a one-off basis and trying to champion your own cause is not going to attract much of a response. We have to have a clear, cogent position put forward to the insurers that they can focus around.
So I guess my to go along with that point, Ryan, is exactly like the self-governing of the industry, self-regulatory environment of the industry. How would you guys say that the industry can hold itself accountable in having those higher standards, similar to what we've seen kind of in different industry spaces that we were talking about earlier?
I go back to it's the subsectoral segmentation of risk. And it's a big way of saying not everybody has the same risk, and we have to delineate the high risk category from the low risk category. And as that gets done, and as underwriters in the community and the regulators start to understand what are the high risk aspects of this and what are the non-high risk aspects of this, that's where I think we see a huge acceleration in the participation by insurers in the industry.
I mean, if we're taking a look at how self-regulation tends to happen or can happen, we need a couple of groups, and obviously, like even at the custodian level, like we all know each other. Like we can come together and say, here's a reference framework for what a custodian should look like. Here are the types of architectures that are acceptable and which types of architecture are not. And what, like this here's a base reference, like stack. And then on top of that, maybe there's inflection points, and there you talk to your underwriter. And then, we just don't do business and we don't engage with the entities that don't follow those standards. More recently, I had a conversation with someone that it was literally 8% APY. Just give me the assets and we'll just put them and we go into liquidity pools and like this and that. And I'm like, are you liable for those assets? They take title. How do you custody them? Like, don't worry about it. And I'm like, that's not gonna work, So we need to start saying no collectively as an industry, those kind of actors and those types of models, right? Start asking a couple more questions, and then over time come together with a reference-based framework that we can all agree on, and hold everyone up to that standard.
Yeah, I certainly agree on the sharing point. So years ago, we put up what we call the risk management framework. It's found on Knox's blog. And it was originally intended to educate regulators to say, when you're doing your technical due diligence on how custody is done, here's some things you can think about. Came to realize, even though we wrote it for regulators, it's been useful to point other custodians, other infrastructure providers, certainly prospective customers and others can actually look at that and say, this is how these people think about risk management from a technical and human ceremonial level.
Great. Well, that about wraps it up. We'll get to some questions here shortly, but is there any sort of last rounding points anyone would like to add? I think for me, main takeaways I would say for everybody is really the education piece, distinguishing yourselves from a general box. And transparency.
I'll do a quick call to action here. So if there's anyone in the insurance industry, like any underwriters in the room, please learn about the space and start serving companies that are in Canada. Every year we have to file a Form B-243 with the CRA that says, here's 10% tax that we got to pay on this premium because we're importing the product. And then every year we have to file a form called E-638. So we're exempted from that 10% excise tax on top of the insurance that we're bringing in. So I would very much like to be done with that process and source it locally. So please start getting involved in the space.
I'll just ask when the hot tub meeting for the custody guys will be to share secrets.
Drinks to share those secrets there, buddy.
Yeah. All right. So Ryan, you'll let me know.
This may be hyper local. If any Quebec people are here, especially from the government, the defense outside the limits problem that appeared in the S&C leveling case really spelled a lot of trouble for a lot of companies in our space seeking things like D&O and E&O coverage. I'm told that legislation is upcoming to change that, but that's an example of sort of absurd situations that we have to face because the regulators aren't doing their right job, or legislators in this case.
Ryan, anything? No? Perfect. Why don't we get to some questions from the audience? Does anybody have any questions? Come on.
They're all sleeping.
Here.
Thank you. We all read about the headlines of exchanges having dramatic losses or thefts or frauds. And Ryan, you were talking about there needs to be data to help the insurers understand the level of risk. Are there any good examples of where a custodian, specifically an independent custodian, has suffered a loss?
I can perhaps cover one, and this is an important thing. In this case, they did not suffer a loss in the sense that technically you can look at it and say, okay, well, it's not really their fault, but Fireblocks induced an $80 million loss on the back of, hey, the customer lost some of the material that we gave them. It's not our fault. to the letter, that is true, not their fault, but it's something that I think, for example, a custody provider should be able to guard against. So it should not be possible for a customer to mess up enough that all of the money gets locked away. So that's the only one large scale I can think of. There was a case, yeah, I'll stop it there.
The most tenured insurer in the space does not disclose their claims payouts publicly. So they're a Bermuda capital company that is non-regulated in Canada that accesses Canada by way of Lloyd's of London. I'm sure many of you know who they are. They don't disclose their claims, and we haven't seen enough claims out of Lloyd's to answer that question. But again, it would come down to which policy type are you asking about? Are you asking on the directors and officers? Are you asking on the errors and omissions? Are you asking on the product? Are you asking on the cyber liability? Like, it's broadly speaking, there's not a lot of great intel in terms of what this industry is generating for losses yet.
Yes, I don't have much of an answer for you either. The data is private, but I guess as a subtle, to your point, as a subtle remark, even if the data for the trading and exchange platforms that suffered losses would be public, I'm not sure how much you can learn from that with respect to porting it back to a custodian. The reason that a lot of these trading and exchange platforms and centralized lenders have sometimes lost assets in hacks and those kind of events is because custody, it not being, a core part of the business to a very large degree, it's a cost center. They don't put the diligence into it that it would require to provide the level of safety and security that a client would expect that a dedicated custodian would. Like, we've been doing this for 5 years, and custody is all we do. Like, that's the whole business, right? I can guarantee you that our solution is a lot more developed than anything you might find at some trading and exchange platform that grew big on volumes and made a lot of money, and custody got built internally as an afterthought.
The one point I will build on this is a lot of the losses that we've seen are bad actors. And if it's a case of a bad actor that management has knowledge of and management doesn't intervene quick enough, then you have the intentional act exclusion that is uniformly in every policy of insurance, because intentional act is not intended to be transferred to an insurance policy. And so even if someone suffered a loss, if there is with the quantums that we're seeing, there is a huge amount of investigation put in, and the SIU, which is a special investigation unit of any insurance company, would be doing a deep dive. And if they can deny a loss on the basis of intentional act, they will every single time.
Anybody else out there?
It would be important to have intelligent conversations with the typical brokers. Why don't you fake some of those and record them to just demonstrate to everybody how that conversation might go? So mock it up and record it so that we can see how that might work.
Well, number one, as sort of educational avenue, absolutely. I mean, we can certainly lead those from a mock standpoint, but as far as recording any sort of proprietary conversations, I think that's outside of my E&O policy and scope as a broker. But yeah, I think from an educational standpoint, and certainly on the topic of Web3 and the metaverse and some of the educational transactions, I think that could be a pretty great learning tool for sure.
It is complicated. Very interesting idea. Like, I'll think about that and I'll see if anything can be done. It is complicated because the underwriting process, to a very large degree, it looks a lot like fundraising. They're setting you a security, right? You're doing a placement. There's multiple parties in the round. The due diligence tends to be as arduous as it is doing fundraising, except that at the end of the process, instead of them giving you money, you're giving them money. So I actually found something that I like less than fundraising, which is getting insurance placed, like in my experience. But yeah, so you do have to go through financials. You have to go through the whole history of the company, and they have to go through books and records and everything involved. So hard to expose, provide much insight into a process like that.
What I can safely say is I think precision is critical. So in conversations, if you're having a conversation with a broker, you need to evaluate their ability to be precise for your needs and precisely understand what you do because they're representing you in the market. So precision is the most important thing. And the products that have been developed by the people on the table or on the panel, they've been done because they went to the market and precisely asked for things. And that is really, it is not widely seen in the market. It's not widely understood in the market. And there's a huge technical gap. Precision is the most important thing. And that would be the takeaway.
Great. I thought I saw.
This question is more for Ryan directly. So earlier you mentioned that custody is viewed as more risky than mining operations. Is that your view, or is that like the theme that insurance see as well?
No, I think there's different risks there, and within each of those categories, there's certainly different risks. So, mining operations, as an example, have a huge fire component to them, and how you manage the heat process, especially the folks that are doing remote mining at stranded gas sites or whatever. So that is every underwriter, depending upon the asset class, will stress and prioritize risk differently. I'm not equating the two. I think they're different, and I think there's different weighting between the two of them. There's a much higher liability for sure on a custodial company than there is on a mining company. A mining company doesn't have the same quantum for liability that a custodian would have because of the fiduciary responsibility.
Yeah, and with custody, it kind of underpins all of the different types of businesses, whether you're a miner or an exchange or a payments company. So that's kind of an area that spreads across all of our respective business lines. So that's kind of an area that the insurers are getting on board with now because it does cover the industry as a whole. And then mining operation specific risks are definitely something that I encourage definitely the mining industry to explain to the insurers the intricacies and the risks that you see and work with them to create policies. Or like I had mentioned, in Alberta, it could be a great idea to get the miners together, put some capital up, create a captive insurance pool together, and underwrite some of the risks that you all agree within the mining community that you all share.
We're already seeing huge advances there. So like within the mining industry, the world's largest publicly traded insurers actually evaluating this at the chief underwriting officer level right now for North America. They have set risk engineering standards, and now they're looking at, okay, so if you've got a remote mine, fine, what is it made out of? The structure, is there wood in there? Do you have fire eyes in there? What is your fire suppression? Like that, the industry's trying to find a way to participate, and they're just starting to gain the data, but it is a much harder, the analogy to fundraising is absolutely apt because it's a much harder natural underwriting for this industry right now to get coverage placed than other industries.
And I get for Kevin's benefit, every policy is going to have insuring clauses. Taking physical loss and damage as an example, the physical loss and damage scenarios for a data center that's running a bunch of S9 ant miners is quite different from the physical loss and damage scenario for a private key material that sits in a bank grade vault that's access controlled, monitored, and guarded 24/7, right? Which is what you'd be insuring in the case of a custodian. So that's why the insurance clauses would be the same, but the content of those insurance clauses and how the loss scenarios apply in real practical terms to the type of business model, that's what causes the discrepancy in premiums and brings about all the challenges in the process itself.
Yeah, I mean, I think at the end of the day, it's, again, to float back to the traditional insurance nature, it comes down to math, and that's sort of the foundation of the traditional insurance market. And, they want to move forward with actuarial data, and they want to find a way to, not miss out on opportunity that's in front of them in helping move things along in this industry space. So, that's what I would leave you with for sure. We're good? Well, thanks so much, everybody. And thanks so much, you guys.
A huge thank you to our panel, and thank you